Have you ever wondered which loan is actually best for buying your first real estate investment? Most beginners think there is only one way to buy rental property. They think you save up a huge down payment, walk into a bank, get approved, buy the property, rent it out, and start collecting cash flow. But once you actually start looking into real estate investing, you quickly realize there are a lot of different loan options. Conventional loans, FHA loans, VA loans, DSCR loans, hard money loans, private money, HELOCs, seller financing, partnerships. And if you are brand new, all of this can get confusing fast. So in this video, we are going to break down the best loans for first-time real estate investors in simple language. By the end of this video, you should have a much better idea of which loan options might make sense for you, which ones probably do not make sense yet, and what mistakes beginners should avoid before applying for financing. Before we get into it, this video is for educational purposes only. This is not financial, legal, tax, or lending advice. Loan rules change, lenders have different guidelines, and your situation may be different, so always talk to a licensed mortgage professional, lender, attorney, CPA, or financial advisor before making a decision. Now let's start with the big idea. The best loan for your first real estate investment depends on three things. Number 1, are you going to live in the property? Number 2, do you already own a home? Number 3, how strong are your credit, income, savings, and debt-to-income ratio? That first question is extremely important. Are you going to live in the property? Because if you are willing to live in the property, you may have access to loan options that require less money down. But if you are buying a true rental property that you will not live in, lenders usually treat that as an investment property, which often means stricter requirements, a bigger down payment, higher interest rates, and more reserves. This is why many first-time investors use a strategy called house hacking. House hacking simply means you buy a property, live in one part of it, and rent out the other part. For example, you buy a duplex, live in one unit, and rent out the other unit. Or you buy a triplex, live in one unit, and rent out the other two. Or you buy a fourplex, live in one unit, and rent out the other three. Some people even house hack with a single-family home by renting out bedrooms, a basement, or an accessory dwelling unit, depending on local rules and lender guidelines. The reason house hacking is powerful is because you may be able to use owner-occupied financing instead of regular investment property financing. Owner-occupied financing usually has better terms than investment property financing because lenders see it as less risky when the borrower lives in the home. So as we go through these loan options, keep this question in your mind. Am I willing to live in the property, or am I buying a pure rental property? That question will determine which loans are even available to you. Let's start with the first loan option, conventional loans. A conventional loan is one of the most common types of mortgages. It is not directly insured by the federal government like an FHA or VA loan, but many conventional loans follow Fannie Mae or Freddie Mac guidelines. For first-time real estate investors, a conventional loan can be used in two main ways. The first way is for an owner-occupied property. The second way is for a true investment property. If you are buying a property as your primary residence, a conventional loan may allow a lower down payment, depending on the exact loan program, your credit, your income, the property type, and lender guidelines. This can be useful if you are house hacking. For example, you might buy a small multifamily property, live in one unit, and rent out the others. But if you are buying a property that you will not live in, then it is usually treated as an investment property. That usually means you should expect a larger down payment, stronger credit requirements, more cash reserves, and possibly a higher interest rate compared to a primary residence loan. The advantage of a conventional loan is that it is widely available. A lot of lenders offer them. The terms can be strong if you qualify. And if you are buying a long-term rental, conventional financing can be a stable option. The downside is that a true investment property conventional loan can require a lot more money up front. For a beginner, that can be the biggest challenge. So who is a conventional loan best for? A conventional loan may be best for someone who has decent credit, stable income, money saved for a down payment and closing costs, and wants a more traditional long-term mortgage. It can also be good for someone who already owns a home and wants to buy their first rental property separately. But if you have very little money saved or your credit is not strong yet, a conventional investment property loan may be difficult. That brings us to loan option number 2, FHA loans. FHA loans are popular with first-time buyers because they can allow a lower down payment than many traditional options. But here is the important thing. FHA loans are generally for primary residences, not pure investment properties. That means you usually cannot use an FHA loan to buy a rental property that you do not plan to live in. However, FHA can be a powerful tool for house hacking. For example, if you buy a 2-unit, 3-unit, or 4-unit property, live in one unit as your primary residence, and rent out the other units, an FHA loan may be an option depending on your situation and lender guidelines. This is why FHA is often mentioned in beginner real estate investing. Not because it is a pure rental property loan, but because it can help a beginner buy a small multi-family property while living in one of the units. Let's say you buy a duplex. You live on one side. Your tenant lives on the other side. The rent from the other side may help offset your mortgage payment. This can help you learn real estate investing while also reducing your own housing cost. That is one of the biggest advantages of house hacking. The advantage of FHA is that it can make getting started easier if you plan to occupy the property. The downside is that you must follow FHA rules, lender guidelines, property condition requirements, loan limits, mortgage insurance requirements, and occupancy requirements. Also, FHA is not always the best fit for every property. Some properties may not meet FHA condition standards. Some sellers may prefer conventional buyers. And if the property needs major repairs, FHA financing may become more complicated. So, who is an FHA loan best for? An FHA loan may be best for a beginner who wants to buy a property to live in, especially a small multifamily property, and rent out the extra units. It may not be best for someone who wants to buy a rental property across town and never live in it. That is an important distinction. FHA can be an investor-friendly strategy, but only when used correctly. Loan option number 3 is the VA loan. The VA loan is available to eligible veterans, active duty service members, and certain surviving spouses. VA loans can be extremely powerful because eligible borrowers may be able to buy a primary residence with no down payment, depending on entitlement, lender approval, and the specific situation. But just like FHA, the VA loan is generally for a primary residence. It is not meant to be used as a regular investment property loan for a house you do not plan to occupy. However, it can be very powerful for house hacking. An eligible borrower may be able to buy a small multifamily property, live in one unit, and rent out the other units, assuming the property and borrower meet the requirements. For the right person, this can be one of the strongest ways to start investing in real estate. Imagine being eligible for a VA loan, buying a duplex, living in one unit, and renting out the other. That rental income may help reduce your monthly housing cost. Over time, you may build equity, gain landlord experience, and eventually move on to your next property. The advantage of the VA loan is that it can offer very favorable terms for eligible borrowers. The downside is that not everyone qualifies. The property must meet requirements, and you generally need to occupy the home as your primary residence. So who is a VA loan best for? A VA loan may be best for eligible military borrowers who want to buy a primary residence and are open to house hacking. It is not the best fit for someone who is not eligible or someone who wants to buy a non-owner-occupied rental from day one. Loan option number 4 is the DSCR loan. DSCR stands for Debt Service Coverage Ratio. This loan is popular with real estate investors because the lender focuses heavily on the rental income of the property instead of only looking at your personal income. In simple terms, the lender wants to know whether the property's rental income can cover the property's debt payment. For example, If the property brings in enough rent compared to the monthly mortgage payment, taxes, insurance, and other required costs, it may qualify based on the property's income. This can be very appealing to investors who are self-employed, have complicated tax returns, or do not show enough traditional income to qualify for a conventional loan. But DSCR loans are not magic. They usually require a down payment. They may have higher interest rates than traditional owner-occupied loans. They may require reserves. And the property has to make sense from a rental income standpoint. A DSCR loan is usually better for someone who is buying a true rental property and does not plan to live in it. So if you are buying a non-owner-occupied rental property, a DSCR loan might be something to explore. The advantage of DSCR is that it can be more investor-focused. The downside is that it may cost more, and the property needs enough rent to support the loan. For a first-time investor, DSCR can be useful, but you need to understand the numbers. This is where beginners get into trouble. They hear, "You do not need personal income," then they think the loan is easy. But the lender still cares about credit, down payment, reserves, property condition, rental income, and risk. So who is a DSCR loan best for? A DSCR loan may be best for a first-time investor who has money saved, decent credit, and wants to buy a true rental property without living in it. It may not be best for someone with very little savings or a property that does not produce enough rent. Loan option number 5 is a hard money loan. Hard money loans are usually short-term loans used by investors who need fast funding, often for flips, renovations, or properties that do not qualify for traditional financing. These loans are usually made by private lenders or companies, not traditional banks. Hard money lenders often care more about the property and the deal than a regular bank would. That sounds good, but there is a catch. Hard money is usually expensive. The interest rate is typically higher. The fees can be higher. The loan term is shorter. And there is often pressure to refinance or sell the property quickly. Hard money can be useful if you are buying a distressed property, renovating it, and then selling it or refinancing into a long-term loan. But for a beginner, hard money can be dangerous if you do not know your numbers. For example, let's say you buy a property with a hard money loan. You think the rehab will cost $50,000, but then the rehab costs $80,000. You think the project will take 3 months, but it takes 8 months. Now you are paying expensive interest for longer than expected. Your budget is blown, and the deal may no longer be profitable. That is why hard money is not usually the best first loan for a beginner unless you have a strong team, a clear exit strategy, and enough cash reserves. The advantage of hard money is speed and flexibility. The downside is cost and risk. So who is hard money best for? Hard money may be best for experienced investors, flippers, or buyers who are purchasing properties that need major repairs and have a clear plan to refinance or sell. It is usually not the best starting point for a brand new investor who has never analyzed a deal before. Loan option number 6 is private money. Private money is when you borrow money from an individual instead of a traditional bank. This could be a friend, family member, business contact, local investor, or someone in your network. Private money can be flexible because the terms are negotiated between you and the lender. For example, one private lender may agree to fund part of the purchase. Another may fund the renovation. Another may lend money for a fixed return. But private money comes with responsibility. You need proper paperwork. You need legal documents. You need clear repayment terms. You need to understand securities laws and lending regulations. And you need to protect the relationship. Borrowing money from someone you know can create serious problems if the deal goes badly. For beginners, private money can sound attractive because people make it seem easy. They say, just find a private lender. But in reality, private lenders usually want to know that you understand the deal, the numbers, the risks, and the exit strategy. If you are brand new, you may need to build trust first. The advantage of private money is flexibility. The downside is that it requires trust, legal structure, and a strong deal. So who is private money best for? Private money may be best for someone who has a strong network, a solid deal, and a clear plan. It may not be best for someone who is still learning the basics and cannot explain how the investment works. Loan option number 7 is a HELOC. HELOC stands for Home Equity Line of Credit. This is a line of credit secured by the equity in your home. If you already own a home and have built up equity, a HELOC may give you access to funds that can be used toward real estate investing. Some investors use a HELOC for a down payment. Some use it for renovations. Some use it as emergency capital. But a HELOC is not free money. It is debt secured by your home. If the investment goes wrong, you still owe the money. And because many HELOCs have variable rates, your payment can change over time. This can be risky if you are not careful. For example, let's say you use a HELOC from your primary home to help buy a rental property. If the rental property has vacancies, repairs, or lower than expected rent, you still have to make the HELOC payment. And if you cannot make the payments, your primary home may be at risk. The advantage of a HELOC is access to capital. The downside is that you are borrowing against your home and increasing your financial risk. So who is a HELOC best for? A HELOC may be best for someone who already owns a home, has equity, has stable income, and has a conservative plan. It may not be best for someone who is already stretched financially or does not have emergency reserves. Loan option number 8 is seller financing. Seller financing is when the seller acts like the lender. Instead of getting all the money from a bank at closing, the seller allows the buyer to make payments over time. This can be useful when a seller owns the property free and clear or has enough equity to structure a deal. Seller financing can be flexible. The buyer and seller may negotiate the down payment, interest rate, payment schedule, balloon payment, and other terms. But just like private money, seller financing needs proper legal documents. You need an attorney. You need title work. You need to understand the risks. And you need to make sure the structure is legal and enforceable. Seller financing can be powerful because it may help you buy a property that would not work with traditional financing, but it is not always easy to find. Most sellers want cash or a normal bank finance buyer. Seller financing usually works best when the seller has a reason to accept payments over time. Maybe they want monthly income. Maybe they want tax advantages. Maybe the property is hard to sell. Maybe they do not need all the cash immediately. The advantage of seller financing is flexibility. The downside is that it can be harder to find and must be structured correctly. So who is seller financing best for? Seller financing may be best for a buyer who understands deal structure, negotiation, and risk. For a beginner, it can work, but you need professional help and a very clear agreement. Loan option number 9 is portfolio lending. A portfolio loan comes from a bank or credit union that keeps the loan in-house instead of selling it to Fannie Mae, Freddie Mac, or another investor. Because the lender keeps the loan, they may have more flexibility with guidelines. This can be useful for real estate investors. For example, a local bank may understand rental properties in your market better than a big national lender. A local bank may be more willing to work with an investor who has a good relationship, strong financials, and a solid property. Portfolio loans can be especially useful for small multifamily properties, unique properties, commercial, style loans, or investors who plan to build a relationship with a local bank. The advantage is flexibility and relationship-based lending. The downside is that terms vary a lot by lender. Some portfolio loans may have adjustable rates. Some may have shorter terms. Some may require larger down payments. Some may require strong reserves. So who is a portfolio loan best for? A portfolio loan may be best for someone who wants to build a long-term relationship with a local bank or credit union and may not fit perfectly into standard mortgage guidelines. It may not be best for someone who has weak financials and expects the lender to ignore risk. Loan option number 10 is partnership financing. This is not exactly a loan, but it is an important way beginners get started. Partnership financing means you work with someone else who brings something to the deal. One person may bring the money. Another person may bring the credit. Another person may find the deal. Another person may manage the renovation. Another person may handle operations. Partnerships can help a beginner get started, but they can also create problems if expectations are not clear. Before partnering with anyone, you need to answer important questions. Who owns what percentage? Who makes decisions? Who signs on the loan? Who handles repairs? Who manages tenants? Who gets paid first? What happens if the property loses money? What happens if one partner wants out? What happens if the property needs more cash? A lot of partnerships fall apart because people only talk about the upside. They do not talk about the downside. So if you use a partnership, get everything in writing and use an attorney. The advantage of a partnership is that you can combine resources. The downside is that you are now tied to another person financially and legally. So, who is partnership financing best for? It may be best for someone who lacks one part of the equation but can bring value in another way. For example, maybe you do not have all the money, but you are good at finding deals and managing projects. Or maybe you have money, but you want to partner with someone who has real estate experience. Now that we have covered the main options, let's compare them in a simple way. If you are willing to live in the property, your best beginner options may be FHA, VA if you are eligible, or an owner-occupied conventional loan. These can work well for house hacking. If you are not willing to live in the property, your best options may be a conventional investment property loan, DSCR loan, portfolio loan, private money, or seller financing. If the property needs major repairs, hard money may be an option, but it comes with much higher risk. If you already own a home and have equity, a HELOC may be an option, but it increases the risk on your primary home. If you do not have enough money or experience, a partnership may be an option, but only if the agreement is clear and legally documented. Now, let's talk about what I would recommend for most first-time investors. If you are brand new and you are open to living in the property, house hacking is usually one of the strongest ways to start. Why? Because you may be able to use owner-occupied financing. You can learn how to manage tenants while living nearby. You can reduce your own housing cost. You can gain experience. And you may be able to get into a property with less money than a traditional investment property. That does not mean it is easy. Living next to your tenants is not for everyone. Managing repairs is not always fun. And being a landlord comes with responsibility. But from a financing standpoint, house hacking can be a very powerful first step. If you are not willing to live in the property, then I would usually start by looking at conventional investment property loans and DSCR loans. Conventional may be better if your personal income, credit, and debt-to-income ratio are strong. DSCR may be better if the property has strong rental income and your personal income is harder to document. But with either option, you need to understand the numbers. The loan is only one part of the deal. A bad deal with good financing is still a bad deal. A good loan does not fix a property that loses money every month. This is where a lot of beginners make mistakes. They ask, "What loan can I get?" But the better question is, what loan makes the deal safe and profitable? Let's go through a simple example. Imagine you are buying a rental property for $200,000. The rent is $2,000 per month. At first, that sounds good. But then you have to subtract the mortgage payment, taxes, insurance, repairs, vacancy, property management, and capital expenses. If after all of that, the property only cash flows $50 per month, that may not be enough margin. One repair could wipe out an entire year of profit. Now imagine you use a loan with a higher interest rate, higher fees, or a short repayment timeline. That could make the deal even tighter. This is why financing and deal analysis go together. You should never pick a loan without running the numbers. And you should never buy a property just because a lender says you qualify. Qualification does not mean the deal is smart. It only means the lender is willing to lend you the money. Your job as the investor is to decide whether the deal actually makes sense. Now let's talk about common beginner mistakes with real estate loans. Mistake number 1 is only shopping for the lowest interest rate. The interest rate matters, but it is not the only thing that matters. You also need to look at fees, points, mortgage insurance, loan term, prepayment penalties, reserves, closing costs, and flexibility. Sometimes the loan with the lowest rate is not the best overall loan. Mistake number 2 is ignoring reserves. Reserves are extra cash you keep available after closing. Beginners often use every dollar to buy the property. Then the water heater breaks, or the tenant moves out, or taxes go up, or insurance increases. Now they are stuck. Real estate investing requires cash reserves. Do not put yourself in a position where one surprise repair can ruin the deal. Mistake number 3 is not understanding occupancy rules. This is huge. If you get an owner-occupied loan, you need to follow the occupancy requirements. Do not tell a lender you are going to live in the property if you have no intention of living there. That can create serious legal and financial problems. Use the loan the right way. Mistake number 4 is assuming rental income will be perfect. Your property may not be rented every single month. Tenants may pay late. Repairs may happen. Vacancy can happen. Rent may be lower than expected. Always build in conservative numbers. Mistake number 5 is getting the loan first and analyzing the deal second. This is backward. Before you fall in love with the loan, analyze the property. Ask yourself, does this deal still work if the rent is lower? Does it still work if repairs are higher? Does it still work if the property is vacant for 1 month? Does it still work if insurance goes up? If the deal only works under perfect conditions, it may not really work. Now let's build a simple decision tree. If you are eligible for a VA loan and willing to live in the property, look into VA house hacking. If you are not VA eligible but you are willing to live in the property, look into FHA or owner-occupied conventional options. If you are not willing to live in the property and you have strong income and credit, look into conventional investment property financing. If you are not willing to live in the property and the rental income is strong, look into DSCR financing. If the property needs major repairs and cannot qualify for normal financing, hard money may be an option, but be very careful. If you already own a home with equity, a HELOC may help with funding, but only if you understand the risk. If you find a flexible seller, seller financing may be an option. If you know someone who can bring money, credit, or experience, a partnership may be an option, but get everything in writing. Now let's answer the question from the title. What are the best loans for first-time real estate investors? Here is my simple ranking. For a beginner who is willing to live in the property, the best options are usually FHA, VA if eligible, or owner-occupied conventional financing. For a beginner buying a true rental property, the best options are usually conventional investment property loans, DSCR loans, or local portfolio loans. For beginners with more advanced situations, private money, seller financing, partnerships, HELOCs, and hard money can work, but they require more caution. The biggest takeaway is this. The best loan is not always the loan with the lowest down payment. The best loan is the one that fits your strategy, your risk tolerance, your finances, and the property's numbers. If you are just starting out, do not try to be fancy. Start simple. Learn how to analyze a deal. Understand your credit. Understand how much money you need. Talk to multiple lenders. Compare your options. And do not rush into a bad deal just because you found a loan. A loan is a tool. Used correctly, it can help you build wealth. Used carelessly, it can put you in a bad financial position. So before you buy your first rental property, ask yourself these 5 questions. Question 1. Am I going to live in the property? Question 2. How much money do I have saved after closing? Question 3. What is my credit score and debt-to-income situation? Question 4. Does the property cash flow after all expenses? Question 5. What is my backup plan if the property does not perform as expected? If you can answer those questions clearly, you are already ahead of most beginners. And remember, you do not need to master every loan option today. You just need to understand which options fit your situation. If you are house hacking, focus on owner-occupied options. If you are buying a true rental, focus on conventional investment, DSCR, and portfolio lending. If you are doing a renovation or creative deal, then you can start learning about hard money, private money, seller financing, and partnerships. Real estate investing is not about knowing every strategy. It is about picking the right strategy for your current stage. So, if this is your first property, keep it simple. Choose a loan you understand. Buy a property you can afford. Keep cash reserves. Run conservative numbers. And avoid deals that only work if everything goes perfectly. If you found this video helpful, subscribe to the channel. On this channel, we talk about money, credit, real estate, rental property loans, and beginner investing strategies. In future videos, we will break down how to analyze rental properties, what credit score you need, how much money you need to get started, and the biggest mistakes first-time investors should avoid. Thanks for watching, and I'll see you in the next video.